Chapter 14, Suitability and Recommendations. Video 3, Portfolio Risks. In this video, we'll discuss how systematic and non-systematic risk can affect investor outcomes. Systematic risks are inherent in virtually all securities and cannot be eliminated with diversification. An easy way to remember which risks are systematic is with the word prime. P is purchasing power risk. R is reinvestment risk. I is interest rate risk. M, market risk, and E, exchange rate risk. Purchasing power risk is also called inflation risk. Inflation means money will buy less in the future than it does today. Fixed income securities have the highest level of purchasing power risk, while equity investments and precious metals may help hedge against inflation. Reinvestment risk is the risk that future proceeds will have to be reinvested at a lower potential interest rate. This is most evident during periods of falling interest rates. Most bonds and preferred stocks will be subject to reinvestment risk, except for zero-coupon bonds. Interest rate risk refers to the inverse relationship between an investment's value and the general economy's interest rates. The risk is measured by duration. The higher the duration, the greater the volatility and interest rate risk. Market risk is the possibility that the value of an investment will decline due to a decline in the market as a whole. Exchange rate risk, otherwise known as currency risk, is associated with foreign investments. The risk occurs as the value of foreign currencies fluctuates against the US dollar. All other risks are non-systematic risks, which can be lessened or eliminated through diversification. Going down the list, capital risk is the risk of losing some or all of the capital used to purchase an investment. Business risk, or selection risk, is the risk that a company will not have adequate cash flow to meet its operating expenses. Liquidity risk results from the lack of marketability of an investment. Credit risk, or default risk, is the possibility that an issuer will default on the interest or principal due to its creditors. Call risk is the possibility that callable bonds or callable preferred will be redeemed by the issuer when interest rates fall. Taxability risk exists when income tax laws change, causing unfavorable tax consequences to security investors. Regulatory risk is the risk that regulations in a specific industry will change, and that will have an adverse effect on corporations in that industry. Legislative risk is the risk that a change in laws will impact a company's business. Social or political risk is the risk that an investment can be negatively impacted due to political changes, social events, or instability in a country. Prepayment and extension risks are associated with mortgage or loan-backed securities. If interest rates increase in the market, loans are paid off more slowly, creating extension risk. And if interest rates fall, loans are paid off sooner than expected, creating prepayment risk. Opportunity cost risk is the risk of choosing one investment or strategy over another. The cost is the difference between the two returns.